Well, hi folks, Jack Spirko here with another edition of Miyagi Mornings. We're going to talk about something we've never actually spoken to each other about before on Miyagi Mornings, and that is buying real estate with owner financing, and specifically buying land with owner financing. This question came in from MeWe, and the basics of the question is, what do you think about owner financing? And the justification for asking about owner financing is sometimes it's really hard to get financing on raw land versus if you're buying a house, your conventional loans. In many instances, it's really not. If it is, often it means the land is overpriced, and that's something we'll get to in a second when we talk about actually doing owner financing. Or the person's expectations are such that it looks like it's harder, but it really isn't. Because if you do owner financing, I'm going to tell you, you're always going to have a large down payment, and you're always going to pay an interest rate higher than if you bought a 3-bedroom, 2-bath on Maple Street and financed with FHA. So part of this is, it is more difficult, and in some instances, I think it's impossible to get some of the loans that are possible on real property as a primary residence, where you're basically getting government assistance with a quasi-governmental agency like Freddie Mac, Fannie Mae type of thing, where the government is backing part of the loan, and you can come in as little as 3% down, and it's really easy to get 30 years on a house. So our good friend Mr. Bill goes walking along, "Hey, Mr. Bill, I want to buy a piece of property," and he looks at a piece of land, and he tries to find a lender, and he has an expectation of a 30-year mortgage with a 3% interest rate. Okay, so my first advice, before you even consider going to owner financing, it'll make a lot of sense why I'm going to say this in a second, don't do it unless you have to, basically, is to make sure that you're doing an apples to apples comparison. Because if you go down to a bank seeking a 5 to 10 year loan on a piece of raw land with 25% down, and you have reasonable credit, if you would qualify for a typical home mortgage, they're probably going to say yes. You're going to pay a higher interest rate and everything, but you're going to do all that and probably pay a higher interest rate with less favorable terms if you do owner financing. Couple things here. Note when I use a word like probably versus a word like definitely. There are some special people in my audience that have to but you're wrong because I do it and I don't do that. That's why I said probably. I think that some special children really struggle with the different meanings of different words. I will also say I have never bought a property with owner financing. I have never sold a property with owner financing. I am not a real estate attorney nor even a real estate agent. I am not acting as one, and I'm giving you my opinion. People who have a problem with hearing other people's opinions should not listen to them. That is your full disclaimer. I will say now, going forward, for the non-special kids, I have bought and sold a ton of real property over time. I've just not used this mechanism of financing. And so as a seller, if I were to consider it, I can put myself into a position that most people that talk about owner financing wouldn't. I would think about everything that I would want to stack to my advantage when it comes to financing a property, but yet I can still put your best interest first because I'm not actually doing it. So you'll usually hear glowing reports about how great the idea is from people that offer it. Wonder why they would do that? I'm pretty sure the person that made this microphone would tell you it's the best microphone on the planet for the money as well. It's a pretty good microphone. I've used it for years. But you get my point. When the person who benefits from you taking the action says it's a good action, not necessarily true, but going into that mindset will help protect you. So this is what I would think if I was going to sell real property. I had a big piece of land. Maybe I'm going to break it up into 20-acre lots, and I'm going to sell and offer that property with owner financing as an option. Number one, I'm going to say to myself, it is most likely the case that the people coming to you to buy this land either are screwed or think they're screwed and can't get a conventional loan, because if you had the option, in most instances, most for the special children, you would not use owner financing because it's less straightforward, etc. I'll give it to you this way. There's one advantage. There's only one advantage to owner financing for the buyer. almost everybody gets approved if they have the down payment. That's it. And anything else you could try to make an advantage, like it's faster or whatever, goes back to that. It all goes back to that, right? So that's the only advantage you really get, is it's easier to get approved. So I know that that's why you're probably coming to me. So either you're screwed or you think you're screwed. So as a shrewd businessman, I'm going to say, self, you need to make sure that you protect your ass in this arrangement, and you need to get a bunch of money up front. So I'm going to require a sizable down payment so that you have real skin in the game. But I'm also going to make sure that I have the most favorable terms to foreclose on you and take the property back as possible. And in many states like Texas, it can be really, really fast and really, really easy in this situation. And you actually would have less emergency time to rectify the problem, try to find some other money, try to find another buyer, etc. If you had a conventional loan, it would be a longer process for a bank to evict you than for me to evict you. And I'm going to make sure I put into the contract every advantage that I can to make sure that I have the most expeditious path for you off my property. Another important note here: what's true in Texas may not be true and probably is not true in California or Oregon or Virginia or even Oklahoma or Florida, right? All this stuff and how the law looks at it and what the process is to get a tenant off a property differs state to state. Texas is a trust deed state. It is a good state to be an owner financer in, and it is a good state to be a landlord in. Other states are not so advantageous toward the part I'm playing right now, the guy selling you the property. I'm going to charge you the highest interest rate that I can get away with, that I think you'll accept and still buy the property, because I want to make as much money as I can. I am not going to finance the property for you for 30 years. I'm not going to do it for 20 years. I'm not going to do it for 15. I'm going to have a relatively short-term financing, and I'm probably going to do it with something that's a big gotcha for people if they don't pay attention. It's called a balloon payment. And what that means is you would have maybe 60 months, and on month 60 or 61, you owe me $150,000 all at one lump sum. That's what a balloon payment is. And it is almost inevitable that somebody doing this type of financing is going to want that balloon payment. I basically want to make a lot more off this property than I would if you walked in and paid me cash for it, right? Because I'm taking more risk. There's also some tax strategy going on here. Let's say I have 100 lots of 20 acres apiece. If I sell them all at one time and I get the cash for them up front, it jacks up my capital gains taxes for that year. If I owner finance them and the money comes in over time, this may be another game that I'm playing. I may be looking at tax advantages so that I can pay less tax year over year over year and have a cash flow. So I may not want something disrupting that, or I may not want something disrupting my, I have now worked out, especially if I'm a bigger investor, I've worked out that this is how much more money these 20 acre or 120 acre lots are going to make me by owner financing them, because I'm seeing it this way. Either you're going to make all the payments and then you're going to make the balloon payment at the end. You're going to sell the property to somebody who's going to have to deal with the terms that transfer. Or you're going to have to deal with the terms of transfer if there's any kind of penalties or anything. But I've kind of locked in that this lot is now worth X% more than it would have been if you walked in with cash. And to me as a seller, if you walk in with cash or you walk in with a conventional bank loan, it's the same. It's 100% the same to me. It might be faster if you have cash. But when it comes down to how it affects me and what happens after the transaction, what happens after the transaction is I have all the money and I go away. With owner financing, I have some of the money, I have a cash flow, and I have something I'm banking on. What does this mean? This means that I might not want that 3 years into the loan, you look at the balance due, cut me a check, and say goodbye. So I might put penalties in there for early payoff. This is the biggest gotcha to look for, right? So all of these things you need to be thinking about, and once you have a contract in hand, you decided you're going to do this, you've taken my advice, you've taken other people's advice, you've looked at land, you've tried to get financing conventionally, you've decided that this will work better for you for whatever reason. You need to take that contract and you need to pay a freaking real estate attorney that's familiar with the law in your state, who's a good one, not one that's 5 seconds out of like just finish the bar. Somebody that's worked in the market for a while. And whatever they want you, it is worth from you to do a contract review. It's worth it. It's probably about $300. And you want them to go through it page by page and point out all the things that you might want to go back to the other party with and negotiate before you sign it. And that can save you thousands of dollars and total misery. So yeah, it's a $300 insurance policy. Take out that insurance policy. You might also realize there's something in there you didn't see or understand and that you don't want the deal and you walk away from it. And being out $300 versus $200 or $300,000 or $50,000 or even $25,000, you are ahead. And then you will learn, and when you do that once with an attorney, you'll get a lot better at it, and the next time you need an attorney to look at something, you'll be like, I need you to look at this and this. And the next time I need you to look at this. Okay? Now, this is a general principle of contract law. You do not, I don't care how much you think it would advantage you, you never want to draft the contract yourself if you don't have to. It is always in your best interest to have the other party draft the contract. Y'all can talk about all the things that you want to agreement and make notes with each other, but in the end, if possible, and with real estate, it's almost inevitable they're going to do it anyway, because this is how these guys operate, they're going to draft the contract. Why would that be to your advantage? Because there's a general principle of law, and that is that if there's something in a contract, and you have no idea what this is until such time as there's a discrepancy, and you have to argue about it, and you can't work it out yourself, and you go to court. So you go to court, you're in front of a judge. And this particular piece of the contract is ambiguous. It could be interpreted one of two different ways. It will, whichever way benefits the party that did not draft the contract, the legal principle, it is to be interpreted that way, to advantage the person that didn't draft it. That doesn't necessarily always happen, but it's supposed to. It is the legal principle upon which a judgment is to be rendered. Okay? Now, again, I'm not a lawyer, but I'm very familiar with that from two specific instances where it came down exactly that way. That, hey, we're not really sure, and this benefits you, Mr. Spirko, or this benefits them, Mr. Spirko. Like, I've been through it. I've seen it, and I'm telling you, most of the time it's going to be adhered to. It's probably not going to come up here, but I wanted to add that in because, again, these types of contracts have been used for so long, most of the ambiguity has been squeezed out of them. But you always want, in any relationship, if you can, to have the other party draft a contract. Right? You have to be a very trusting party if you're going to be the one that drafts the contract and you didn't have to. And that is very seldom that I would put myself in that place. 1-to-1, I'm better at it than you are, and we're working together on something. Sure, large concern. I don't want to draft it if I don't have to. And if you make me draft it, I'm going to draft what I think. I'm going to hand it to a lawyer. They're going to make it a final contract. All right. So, how would you use owner financing in a way that would make sense? Well, if you can avoid penalty for early payoff, then you have an opportunity here where we can go from a raw land loan to a conventional real estate loan in a fairly quick period. So it would benefit a person who knows they can get a construction loan. And what you're going to do is you're going to owner finance the property. You're going to build the house. You're going to go to a bank and say, here's an appraisal. Here's how much I want for a mortgage. And that's going to be a much bigger number than what's owed on the land. And you're going to say the only outstanding debt on this piece of property is this right here and this right here. And the bank will give it to you probably with the contingency that you must pay off those debts with part of the mortgage. And now you've taken a piece of property for some reason you couldn't buy with a conventional loan or a government loan or a VA loan, and you've turned it into a property that you can finance that way. And now you've gotten into a property that otherwise you could not have gotten into. That works. But again, you have to look at, is there a penalty for early payoff? Is it too big? Can I make it go away? Right? And you also have to look about how much I'm paying for the property. I'm probably going to sell the property to you for more, and you need to be looking at how much you're paying for the property, not what the sticker price is. If the property says it's $45,000, But in only 5 years' time, you have to be completely paid out on it. You put in $70,000. To me, you paid about $60,000 for the property in real money. Because there's a cost of capital in there, but that's much higher than a standard cost of capital. So you need to figure that out for yourself as well. Another way is if you are a land flipper, right? This can be an outstanding way to do business if you can avoid the penalty problem, right? So if you're the kind of person, you go into, you buy a piece of raw land and it's just shit, and you own a bulldozer and an excavator, or you can lease them, and you know how to operate them. You have a low-cost methodology to come in there and put in a home site and make this property ready to go, where a more conventional, affluent buyer would be like, yes, that's the property I want. Then this can work because you're only on that owner financing for short term. That's where this tends to work best overall, is a short-term hold. About the only way I can think of it working with a long-term hold. You find a piece of property, and it is really fairly priced. And the landowner simply prefers owner financing because they feel that they benefit by having a long-term cash flow. And the terms that you're getting are not very different than you would get in a conventional mortgage. That landholder, for whatever reason, is willing to be abundantly fair and give you a deal just about as good as the bank, or you feel that he has seriously undervalued his property and you're getting a smoking deal, and when you add the cost, you still feel it's a great purchase. Because one of the things that will not have to happen here is this property's not going to have to be appraised. So when you go to a bank and you go, I want to buy this piece of land and it's $50,000, they're going to have it appraised. Not the way that you appraise a property with a house on it, but they're going to be like the value of land in this condition, in this area, on the market is X. And they're not going to loan you more money than that. You're going to have to make up the difference with, deposit. They're only going to loan so much against value. If the guy screwed up and he's undervalued his land, if you are doing owner financing with somebody and they just kind of want to deal with it private, those ways work out. Otherwise, it's really a short-term solution, and it's either a short-term solution by design on your end or a short-term solution by design on their end. I've never seen, now again, I don't deal in this much, but I have never seen an owner financing agreement longer than 10 years on raw land. That is the longest that I've ever seen. And most of them that I've seen are 5 years. And when I say seen, what I mean is I go on LandWatch and I see a property that says owner financing. And a lot of times that listing agent or that listing seller will say, here's the owner finance terms. And inevitably, 99% of the time, it's a 5-year term with a balloon payment. And that balloon payment seems a long way away when you're at, month 2 and it's 60 months. But time flies when we're having fun, friends. So those are all the things to think about. I'm not saying not to do it. I'm saying make damn sure you even have to. I think so many people make bad financial decisions due to assumptions. You should not assume that it is more difficult. I've known people that have gone out and bought raw land with a VA loan, even though it's supposed to be difficult or impossible to do, but they bought it with the intent to build. They had a contract in hand to build, and they basically financed the property as though the house was already there with contingencies the house get freaking built. Always, go down, find a local bank or credit union that does lending for this. Talk to someone and ask them, what do I need to do to qualify for this type of a loan? Don't write it off before you give it a shot. And don't just write off owner financing due to anything I said today, but damn well know what you're signing before you're signing it. And if it's your first time in the kiddie pool, go to someone who's done it before, who understands it, and make sure that you actually understand it. There's a big difference between reading a contract and going, I understand what all this means, and a lawyer reading a contract who spent, 4 years in school, 3 years in law school, couple years working with a partner firm, finally passes his bar, and he's lived and breathed this language for that many years. Don't cheap out on $300 to $600 for that contract review. All right, with that, guys, take care. I'll be back tomorrow with something totally different.